You are listening to Agriculture Today. Roger McEowen, our guest now. He's a professor of agricultural law and taxation, Washburn University School of Law. With us every other Wednesday and in studio with us today. Roger, good to have you by. And what we want to talk up today is a tax filing matter of interest here that you've covered in one of your recent blog articles. And it's the allowance to producers who conduct soil and water conservation activities on their land, the deduction of those expenses as tax law reads. And this is something that certainly appeals to a great lot of producers out there and applies to them.
Well, it does, and it's an important aspect of tax law that I'm hopeful that many farmers know about. I think many farmers are very familiar that when they put in conservation structures on the farm, that USDA will cost share with that, and many times that's a 50% cost share. And so we're talking about something kind of in that same vein, but for the expenses for which USDA does not cost share. You can still perhaps get a tax write-off associated with those expenses, and even if it's not a cost share expense by USDA. We're talking about any type of conservation expense that's consistent with an NRCS approved plan or a state plan, if there's not an NRCS approved plan, that you might be able to get a deduction for.
Mm-hmm. And there are stipulations, of course. It's not wide open. And one thing that needs to be clarified is what expenses are specifically deductible under the code.
Well, any expense that's paid or incurred for soil and water conservation on land that's used in farming, and we'll dig that out a little bit more here in just a moment. So land that's used in farming or for the prevention or erosion of farmland. So it's a very important provision, and this one picked up importance basically in the mid-1980s with the 1985 Farm Bill. That's where the conservation title came in the 85 Farm Bill, and Congress made some changes in the tax law, and this was one of them, to kind of correspond and have the incentives line up in the tax code with what Congress was trying to do to promote soil conservation and stewardship of farmland in the 85 Farm Bill. Mm-hmm. So we're going to allow an expense deduction for these types of expenses, but at the same time Congress changed the rules and they said, well, you can't take a deduction for land clearing activities where you're going to clear the land and put it into production. That had been in the code up until the time of the 85 Farm Bill, and then they decided, well, that's kind of at cross purposes, so we'll take that out. But important for our Flint Hills producers is they left the provision in that says that routine pasture maintenance expenses are still deductible. It's not really what we're talking about here. It's related to it, though, because that's good pasture management techniques. And even though they took the land clearing provision out, they said you can still maintain pastures. So routine brush clearing in pastures, those expenses, we want to make sure we record those. And if we're engaged in a farming business, we can write those off.
Typically, though, we think of other practices on the land, what you might call normal conservation measures, such as terrace building and irrigation ditches and so forth. Those fall very well under the deduction allowances here.
Yeah, that's what we're talking about here under Section 175 of the code. So if I have to, as part of my soil and water conservation plan, if I have to build a terrace, if I have contour furrows, if I'm doing conditioning, grading of the land, leveling of the land that my conservation program requires me to do, then that's what this provision is all about. I can write those expenses off.
One has to actually be a bona fide agricultural producer to qualify, though, and that's one of the points of emphasis here.
Yeah, the sticking point on that one often is we get cash rent landlords, and they try to take these expenses, and the answer is no, you can't, because IRS says you're not a farmer. If you're a cash rent landlord, you are in a rental business. You're not in a farming business, and the key to getting this deduction to start out with is you have to be a farmer. So that means you've got to check your lease arrangements if you're a landlord and make sure you have at least a share lease. Now, it doesn't necessarily need to be a material participation crop share or livestock share lease, but it needs to be a share lease. So any type of arrangement other than cash will suffice in this instance. But you got to stay away from those cash leases because that's a rental activity. It's not a farming activity.
And the land itself has to be used in quote, farming.
Yep, that means the land is used by the farmer or the taxpayer or the tenant, is the way the code reads, for the production of crops, fruits, or other ag products, or for the sustenance, as the code says, of livestock. So we're using it in livestock production, we're using it to grow crops, either myself or my tenant.
And as you said a moment ago, if that land was not previously in farming, one cannot implement these practices and claim the deduction.
Right, but prior farming activities by a different taxpayer does count, as does a different type of agricultural use.
And NRCS plans, Natural Resources Conservation Service plans, are a very important cog here in as far as identifying the eligibility of a practice.
Yeah, that has always been a key point when we came with the 1986 Tax Act. They really tried to tie it to the conservation title of the 85 Farm Bill, and so they said, okay, you need to have deductible expenses. In order to have those, they have to be tied to an NRCS approved plan. But as I said earlier, if you don't have one, you could have a state plan or a local plan. Now, I'm not aware of too many of those. So the big one here that we're talking about are NRCS approved plans. Mm-hmm. There are some limits that come into play, too, when you get into this. I mean, you're not going to get necessarily every expense, but you have to watch a 25% threshold. The deduction cannot exceed 25% of your gross income derived from farming during the tax year. Well, that brings up some other issues. Well, what is income that's derived from farming? What's gross income from farming activities? Well, that includes, gain from the sale of, as the code says, draft, dairy, or breeding livestock, or even livestock that are held for sporting purposes, but not if you sell machinery or land. So your gains from the sale of farm machinery or farm land don't count as gross income from farming. And if you go over that 25% threshold, then, well, all you do is you carry over the excess into the next year, subject to the same limitation in that year and so forth and so on.
How is this deduction claimed? Is it fairly straightforward as the process goes?
Yeah, right now it's line 12 of Schedule F that's associated with the 1040. That's where you're going to take your soil and water conservation expenses. And if you don't claim them, now you don't have to claim them, but if you keep track of them and you don't claim them as an expense deduction, you just add that cost into the basis of your land. And so that'll give you a higher basis if you ever sell the land and reduce the taxable gain on sale. But that's not an upfront deduction. That's postponed until you would sell the land to actually realize the tax benefit.
There is a concept here that bears explanation, and it does get a bit complicated. The recapture provision of all of this. Explain what that is and how it fits in.
Well, recapture in the tax world is a dirty word. It's one of those so-called four-letter words when we get into tax. And what recapture means is you got a benefit. You received a tax benefit, and you did something naughty that requires you to pay it back. That's what recapture is. The government recaptures the tax benefit it previously allowed you to have. And that applies in this situation. So if I, in 2022, claim soil and water conservation expense deductions on my land, and then I sell that land within the next 10 years, there's going to be some recapture. Now, it's 100% recapture of the tax benefit that I received if I sell the land within 5 years of taking it. And then it's a sliding scale, years 5 through 10 or 6 through 10, 20% reduction. So year 6, I'd have 80% payback, 7, it would be 60, so forth and so on. But once I clear the 10th year, then I'm okay, and there's no possibility of recapture after that. But that is something that we have to worry about.
And something that you need to work through with your practitioner if you're going through some sort of land transaction of that nature. But it's a very useful tool in as far as tax management for producers, and there's no reason for a producer who is carrying out these practices to not take full advantage of that.
Oh, absolutely, particularly as margins in agriculture as tight as they are. We want to get every tax benefit we possibly can. This one, with anything in tax, I would emphasize on this one, keep good records. Keep good records of your expenses, of what you're doing on that property, so that you know whether you want to make the decision to currently deduct or add it into your basis. And then get with a tax professional that knows all the rules and can guide you through this. There is a pretty good discussion of this in the Farmer's Tax Guide, but they don't get into the nuances of the case law and the regulations and so forth. But it is a helpful provision. Often we have to put in conservation practices as a result of an NRCS approved plan. Get the most tax bang out of it that you possibly can.
If you'd like detail on what we've been discussing today, it's all covered in the blog article that Roger has put together on deducting soil and water conservation expenses. It was posted on Monday, May the 16th, and it's at the usual location we remind you about. That is the Washburn University School of Law website, washburnlaw.edu/deducting. WALTR is the direct address. As always, Roger, a pleasure. Thanks for sharing this with us right here.
Thanks, Eric.
He's a professor of agricultural law and taxation out of the Washburn University School of Law. Roger McEowen. We'll be back shortly. This is the K-State Radio Network.